Good morning, folks, and welcome back to Almus Market Mornings. Let's focus on Chair Powell's speech because he mentioned something important yesterday. So, in his speech, he spoke largely in line with his previous commentaries, that is, that the balance of risk is shifting and there is downside risk in the labor market. Essentially, he's saying that the rate cuts are likely. Interestingly, he also mentioned that the Fed in the coming months may stop shrinking the balance sheet. That's important because we are in an easing cycle and reducing the size of the balance sheet often tightens the money market liquidity. Powell himself highlighted that the current pace of QT, or you may call it the reducing the size of the balance sheet, is causing some tightness in liquidity. Good morning, JK. What's your take on Chair Powell's speech? Not much change in probabilities. October looks like a done deal for a rate cut. What's your take?
Uh, Good morning, Swaraj. Yes, apart from QT, Powell also mentioned about the job market actually looking weaker, saying that unemployment rate remained low through August, and payrolls have slowed sharply, partly due to decline in labor force and also lower immigration. But this dynamic has actually led to a softer labor market, and the downside risk to employment appears to have risen. This is a clear indication that is preparing the market for another rate cut in October meeting, and markets are already pricing October and December rate cuts, followed by three more rate cuts next year. Yes, on the QT, he's saying seriously considering winding down of QT in the near future. Uh, but no timeline is mentioned. It is quite cautious that he's actually signaling a readiness. But what they will be watching closely is the liquidity indicators, that the repo rates, reserve levels, and the money market, stress to confirm that QT can be ended. Recently, we have, seen that some amount of, reduction in the repo was observed. Repo balances were observed, but that must have actually then improved, which has led to this, decision about QT. But other factor that also makes me feel that Fed is ready to cut rates is the big fall in crude prices that has been seen. In fact, in the last 3 weeks, crude prices have fallen by 10%. Now, this can actually offset any a major portion of the tariff driven inflation higher. So that makes the headline inflation definitely lower. Of course, a caution is needed because it some of the experts feel that OPEC may be done with the output hikes rather, and we are almost at 62 for the Brent, and somewhere around 60 is where we had seen a big spike in the oil prices, in May. But then that was also a time when the Middle East war was in full flow. So currently, the conditions are much better for oil prices to stabilize at lower levels, and that gives a helping hand for Fed to actually cut rate. And of course, QT will depend upon, as I said, about the liquidity positions, and that's the sole guiding factor for. For Fed in the absence of any major market or economic stress. Of course, in the global market, we did not have much of economic data except the Zook economic sentiment from Europe that actually once again showed some decline, and it's a cautious responses from the people who have been surveyed. And I think the recent political turmoil could be one of the factors, and also the tariff issue. So these are the factors behind that. And across in UK, the unemployment rate went up to 4.8%, and this is the highest level since 2021. Is also a wage inflation that has come down. So overall, we can also see some of these regions all maybe looking at the monetary policy closely to see whether further easing is needed. Definitely, I think UK is on course for at least another rate cut. So all that makes for the dollar to be slightly stronger. Yes, now currently there is mixed factors. Now the talk about QT has actually led to the dollar being sold against the euro. There was another factor where the ruling the new prime minister, the reappointed prime minister of France, shelved the pension reform plan, which they wanted to reduce the retirement age. So that actually has been shelved because of wide protests as well as opposition from the coalition partners. So that ensured some sort of a political stability in the near term, but at the same time, it has a negative fiscal implication. So once again, the budget is going to be showing a large deficit, and how it is to be funded, etc., will become a question. Money market rates might also go up again because of a larger borrowing by the government. So it's a mixed implication. Short-term relief for euro. So that's we've seen euro was threatening to break 1.1550 yesterday, and now it is back above 1.16. But technically, both euro and GBP don't look like they're going to put up more gains, and this is just a pullback. And overall dollar does look like it can maintain its strength because although Powell did talk about QT and also the weakening labor market. They will always go in a calibrated manner as far as the rate cuts are concerned. They will continue to watch more data, in the coming months, particularly on the inflation front. Therefore, I think still at a good, growth rate of over 2%, and US assets are performing well. US dollar demand is not going to go away for some time. So the dollar remains stable to slightly stronger for the time being, until we see any large scale diversification from the central banks towards a dollar. So far, what we're seeing is the central banks have diverted more money into the gold, and the data also shows that central banks now hold more gold than the US Treasury bonds. So that clearly shows where their actions have been diverted to. So until they switch to more attractive and stable, alternates to US Treasury bonds, I think this the dollar stability will be continuing. For the rupee, again, a couple of attempts to gain did not sustain, and again the demand has been overpowering. Market is still skeptical when the trade deal will happen. While we have some optimistic statement from the Indian government officials, we are not seeing any statement from the US side about getting closer to an agreement. So that could be leading some caution in the minds of the forex stakeholders. So while of course international agencies have slightly upgraded growth of FY26, both IMF and World Bank, they have also downgraded growth for FY27, citing the global conditions, also the pace of reforms that needs to be speeded up, and also the investment gaps in India. So these things, so this is very important from the medium term perspective of global investments, which has been actually on the decline in India for the last 2 years. And that's a very key factor as far as India's forex stability is concerned. Without global investment flows, I think the rupee will not be able to maintain any strength, even if the dollar index is easing. So I think some currently the rupee is holding in a range. Perhaps even the policymakers as well as the markets are in a situation of observing how things evolve over the coming months, and then only you will see a definite direction emerging for the dollar rupee. I think 88.50 and 89 in a broad range is what is going to maintain for quite some time now. Thank you.
Thank you, JK. And yeah, a lot of insights from Chair Powell's speech. Again, October rate cut looks quite likely. That's what he's preparing the markets for. We spoke about quantitative tightening, the winding down of QT actually, but there's no timeline mentioned. For the Fed, somewhat of a positive situation is also the fact that oil prices are lower. In the last 3 weeks, oil prices have gone down about 10%, and that helps keep inflation subdued. Otherwise, dollar relatively was slightly stronger, but again, the talks of QT has seen dollar weaken again. But as JK mentioned, overall in the larger scheme, it seems dollar can maintain its strength. Rupee's attempts to gain did not sustain. It traded at the weaker end of the range, 88.80 being protected by the central bank as of now. The broad range is 88.5 and 89. That's it from us today. Thanks for listening. We'll catch up tomorrow with the fresh round of updates.